Let's, what I'll do is very quickly survey for maybe 5-10 minutes what we did last time and try to get, again, as much as possible from chapter 1. We begin with investment classes. We said that investment class is a set or a collection of assets with very similar properties, very similar characteristics, and most important, similar price behavior. Similar price behavior we define as very high correlation, or if there are more than two, very high covariance in their price fluctuations. The five, there are exactly five asset classes: stocks, bonds, real estate, commodities, and currencies. We like to separate currencies in a separate asset class. When we have currencies as a separate asset class, this always guarantees, no matter which asset class behaves how, meaning which asset class goes up or which asset class goes down, there is always guaranteed at least one of those five to be going up relative to the others. So it is absolutely impossible all five asset classes to go down once you add the currency. So everything goes down means at least the currency is going up relative to the others. Then we separately divided assets into real assets and financial assets. Real assets included commodities and real estate. Financial assets included stocks, bonds, and currencies. We also mentioned that there is one grand exception to all of these, and this is gold. Gold is counted as a currency on the one hand and a commodity on the other. It also counts as a financial asset. It is a real asset. It is the only asset which belongs to two asset classes, and it also belongs to the real and the financial one. Alright, let's see. In terms of bonds, we mentioned we have a lot of different types of bonds. You have government bonds, municipal bonds, you have, corporate, state, government. So we have hundreds of different types of mortgage bonds, etc. So a bond is an instrument of debt. Instrument of debt. Debt means that it has a higher priority of a claim on the asset's income or the asset value itself. So you have a claim on either the income or the asset itself. So this is with respect to bonds. With respect to stocks, we call these instruments of ownership or instruments of equity. You have a lower, for stock, common stock, you have the lowest priority, and we call it a residual claim. Residual claim. So stocks will have qualify as, usually, we have at least 10-15 different types of stocks, but the big one is common stock, and then there is preferred stock. Within preferred stock, you have them with cumulative dividend, cum dividend, all those different variations that we probably will not study here, which is properly a subject of corporate finance. You also have a lot of instruments which are hybrid between debt and equity. Sometimes you will have debt being convertible to equity. You have different, we are not going to discuss these in detail. What you're expected to understand is the pure properties of each asset class, and then when you have a hybrid, you're going to be able to figure out by using common sense financial logic. Alright, we mentioned what is default, and default is inability to pay in service an obligation, usually debt payable in money, but it's in general an obligation, on time and in full. Alright, that's very important. You also have risk, and risk is the chance or quantitatively, mathematically, we define it as a probability of an unfavorable outcome. Now, the most common mistake, which the previous class immediately shouted at me, was that it was the risk of the risk is actually of a loss. The answer is not necessarily a loss. You buy a house, you expect it to go up 15%. The good chance is that you can actually get a 25%, and the risk is that you might be getting only 5%. In other words, plus 5% is still a positive return. Loss is defined as a negative return. And when you have risk, risk does not necessarily mean a negative return. Alright? An example of a positive return risk will be inflation, the return of a bond. You have a government bond. The government bond gives you 4% guaranteed, fixed, no matter what. And the risk is the risk of inflation. You expect 1% of inflation. So your nominal return is 4%. The real return is 3%. But you are risking, or your risk of inflation is that inflation will turn out to be 3%, so that your real return is only 1%. The point I'm making is that you may have risk, and risk is not necessarily associated with a loss. It is associated with a less favorable outcome. Well, what about weather risk? I mean, you do have weather risk. And when you have a bad weather, doesn't mean that you're not making a profit. For an agriculture, a farmer, he might be expecting 1,000 bushels per whatever acre. I'm just giving an example. And with a bad weather, he's going to be making 950 bushels. He's still going to be making a profit. He's still going to be doing okay. He's not going to be starving, but it is nevertheless a weather risk. Alright, from risk we get the concept of a risk management. Usually risk management is not associated with one asset, it is associated with a whole portfolio. A portfolio is, let me repeat, a set of assets which are considered or regarded as one. We also, instead of set, we say a collection of assets. So it's a collection of assets which we regard as one. So risk management is essentially a management, meaning an attempt to evaluate and control the overall risk for your entire portfolio. So you studied management. Management has 4 functions. The key one is, number 1 is plan, measure, evaluate, and possibly control, meaning the feedback loop. In other words, take corrective action when it's necessary in order to control risk. The early definition of a risk is actually the sigma, which we call a standard deviation, or the variability of returns. You may have only 2 outcomes, plus 15 and plus 5, and the standard deviation will be, I don't know, 6 or 8, whatever the percent is. You can just compute it, depending also on the probabilities of the outcome. Alright, so let's see, financial markets and the economy. One of the important, let's say the most important concept in finance is risk. So number 1, you have risk management, the attempt to manage it. A completely different concept is risk allocation. Some people are more risk averse. Let me clarify here. A lot of people use the word incorrectly. They pronounce it as risk adverse. Adverse. There is no risk adverse in finance. It is risk averse. Averse means trying to avoid something. Adverse means unfavorable. So it's only risk averse, and the noun becomes risk aversion. So, one of the key functions of financial markets is to allocate risk to those that are, from those that are risk averse, which means they don't want to take or assume much or any risk, to those that are willing to take the risk. Those that are willing to take the risk will expect a proper return, meaning a compensation for assuming the risk. In other words, one of the key functions of financial markets is the transfer and allocation of risk. The assumption, as an example, is that a farmer is not willing to assume the risk of price volatility of his crops. He already knows early in his academic year what are his input prices, meaning his costs and expenses, and seeing a particular price of his output, for example wheat, he can estimate that he will get between 15 and 20% profit. Well, we sometimes call it return on capital, and therefore he might be willing to lock in this price. Well, to lock in this price today for 8 months from today is essentially a derivative instrument. It is a classical form of futures. Well, futures is essentially for the one party the transfer of risk, and for the other party we call it the assumption of risk. So one will, the other will bear the risk. All right. So some of the problems in finance in general in investing is associated with agency problems. Agency problem is associated with the so-called principal agent problems. As you all well know, America and American financial system has been rife with corporate scandals. These are corrupt CEOs that are usually greedy. They get like $50 million or $100 million bonuses for doing next to nothing. Well, they actually for driving major corporations into bankruptcy. The latest corporate scandal is associated with financial institutions that are in deep trouble, meaning they are technically already bankrupt, but their bankruptcy will trigger a domino effect. We also call it a contagion effect, where the collapse of one major institution will certainly drive the bankruptcy of the whole financial system, because they begin to fall like dominoes. One financial institution usually will have claims on another financial institution. So when the second financial institution goes bankrupt, the first financial institution cannot collect its claim, then the first is bankrupt, and we call it also a chain reaction. In a chain reaction, the whole banking system locks up and completely collapses. So, what the government is doing in the United States is held hostage. Held hostage means that financial banks or institutions we call it racketeer the government for bailout. What does it mean, a racket? It simply means that they are telling indirectly the government, you gotta give us $50 billion to bail us out. If not, you risk a nuclear, actually there's going to be implosion of the whole banking system. And the government is held hostage. The government has no choice. The government, it has a gun to its head, and it's got to put up $50 billion. So, what are these guys doing with the $50 billion bailout? That's the recent bailout. That's the recent scandal just a couple of weeks ago. Is first of all, they threw themselves lavish Christmas parties. All right. Second thing they do is they gave themselves $1 million bonuses. Hey, they're bankers and they work on Wall Street. They deserve it. All right. So, $1 million bonus. So, they get $5 billion for bailout money, and out of these $5 billion, they use $2 billion to give themselves to each other for bonuses. The previous scandal was government gives them $10 billion, and what they do is use a bunch, the big bulk of those, to give themselves dividends. instruments. Alright? Well, this is not what you're supposed to do with government bailout money. So, in general, what you have to understand is that let's call it agency problems are pervasive in the financial system, in the corporate world, especially in the Western world. Most of the corporate CEOs have gotten the mentality that they are entitled to tens or hundreds of millions of dollars. They award themselves those millions one way or another, and they are effectively ripping off the shareholders. Well, who is the shareholder? Well, this is an investor who purchased stocks. So, when you're purchasing a stock, a major risk which you're facing is that management will be corrupt and actually will be stealing from the company, a lot of times perfectly legally, if the board of directors declares a 20 million bonus to the CEO for a job well done. This is perfectly legal. This is not legally or technically theft. But did the guy deserve 20 million bonus? Alright? That's a whole different question. So if he did not earn it and if he did not deserve it, this is what we have the concept of kind of like theft. You know, he was robbing the shareholders, but the shareholders are investors and portfolio managers. Well, portfolio managers don't care anyway, but that's a different type of moral hazard problem. When you have a portfolio manager, what he cares most about is to outperform the other manager. If you know the index provides a minus 20% return and you actually lost only 18, you outperformed by 2%. On Wall Street, you're a hero. You lost, you managed, let's say, $5 billion portfolio. You lost like that $1 billion, and for losing $1 billion, you treated like a hero because you outperformed by 2%. All right. Of course, this is perverse logic. They call them heroes and they're great and everything else for losing a lot of money. But they call them heroes because they didn't lose as much as the others. All right? Well, there is nothing heroic about losing a little less. You're the good guy only when you're making money, making good money, and making more than the others. By the same token, in Bulgaria, I was really totally baffled. You have these pension funds reporting during the bubble times some extraordinary return of 15 to 18%. Say, what's wrong with you guys? The stock market in Bulgaria is providing 45% return. The stock market index, the complete index, we have two indices. One is called BG40, the top 40 stocks, but we've got only 50. The other one is called SOFIX. The stock market returns 40%. The fund manager returns 15%, and he declares himself, I'm a hero, I'm the greatest investor in the world. Well, apparently he's totally incompetent if he's merely making 15 when the stock market is delivering 40. There's got to be something wrong with that. I mean, if he invested the money in oil at those times, he'd be making 50%. If he'd been investing in gold, he'd be making 35%. If he'd been investing in, let's say, even the Chinese market at that time was given 50% returns. In other words, they delivered a terrible return, but they declared themselves hero when there was nothing heroic about making 15%, but the market provides 40%. In other words, you got to get to understand that mentality of what the claims are, because mostly the claims are technically and legally correct and factually correct, but the interpretation is totally wrong. Alright? Let's see what else we have. Compensation plan, that's okay, so let's define the next term is corporate governance. So corporate governance is the process or attempt to manage the problem of principal agents. where corporate CEOs are kind of like ripping off shareholders. In other words, what you try to do is structure a proper compensation plan in order to provide proper stimulus for CEOs to behave in the interest of shareholders and not in their own interest. Well, CEOs will always behave in their own interest. What you want to do is align the interest of the CEO to the shareholders. What was incorrectly believed in the 90s and even for the last 3 or 4 years, that if you simply give them options, and they can exercise only those options if the stock price went up 10, 20, 30%, that this will align the interest. Well, now we know this was totally and completely wrong. If you give them an option that is out of the money, let's say 30%, what the CEO will do is pump the stock price. You know, they're lying and cheating. Of course, they usually just manipulate. They use accounting tricks and accounting games. They massage the earnings, the cash flows, and everything else. They show extraordinary growth for 2 or 3 years. Investors incorrectly get fooled and incorporate this growth into 10, 20, 50 years or infinity and boost the price. Let's say, you understand, if the company grows instead of 5% or 10%, this will justify literally doubling the price of the stock. So suddenly you simulate for 2 or 3 years that the company grows instead of 5 or 10%. Suddenly the fundamental value appears to be twice more. Your strike is 30% up. You're able to generate an artificial boost of 100%. And the corporate CEO and all the insiders strike it rich. Alright? This means they cash out the options and then they can bail out ship. Alright? Well, 2 years later, everybody realized that the 10% growth forever is a mirage. It's a myth. It wouldn't come true. And when they readjust the growth to more realistic 2%, suddenly the value, the fundamental value of the stock, as you have started before, could easily fall 3 or 4 times. Well, when it falls 3 or 4 times, the ultimate losers are the shareholders, the investors, but the CEOs and the insiders, they cash 10 million, 20 million, $500 million, whatever they cashed out, and the shareholders can do very little about it. Shareholders knew the risks. Well, the problem was that most of the shareholders in America are actually, number one, small investors which didn't really know and didn't really understand the risk because they didn't get a finance degree from an elite institution like you are. All right? They never had a course in finance. Media was telling them it was great investment, all right? And the other group were fund managers who don't care what's happening up or down. The only thing they care is to outperform their peers, all right? Usually on the risk-adjusted basis. All right, let's see what's next. Analyst scandals, yes, of course. You should, this is one of the golden rules. You never, ever trust an analyst. Analyst's job is not to analyze. Remember, this is on my textbook, page 10. I don't know which is your textbook. You got to remember that analyst's job is not to analyze. It never was, it never is. The job of an analyst is that of a salesman. Salesman. He's a stock pusher. He pushes a stock just like a street drug dealer pushes drugs. His job is not to analyze. His job is to get an ugly pig, put a lipstick on it, make it nice, beautiful, and sell it to the public. This is what analysts do. That's number one. Number two, what you got to understand about analysts is that usually you don't get the old white-haired analyst. You usually get a 23, 25-year-old young guy coming from a elite university like Harvard, Princeton, or whatever, Yale, and the guy knows next to nothing. He just basically took one course in corporate finance, one course in essentials in investment, but he claims this big brand name, Harvard, which makes him like a god in investments, but instead he's still an immature guy. And he suddenly gets pumped up on dot-coms or telecoms. Well, they were really pumped up on construction companies like, real estate will never fall, construction is always good and whatnot. Well, now we know that these same construction companies, which 2 years ago they were giving buy ratings, 80% of those construction companies are now bankrupt, non-existent. And the other 20 have gotten billions of dollars of government bailout. So, you never trust analysts. Another general rule of real-world investing is you never trust investment bankers, alright? Well, now they're all, bankrupt, right? Investment bankers are, most of the investment banks actually, destroy themselves. They're currently bankrupt. So, you don't get any of those. But interestingly, I still read analyses from Merrill Lynch. Now they were merged by Bank of America, BOA-ML. They continue to deliver these garbage reports over and over again. And why would any common sense investor in the world will ever trust them is beyond logical comprehension. They bankrupted themselves, alright? They needed tens of billions of bailout money. They got, come on guys, penalty point for each. Send me an email. You can't do this kind of stuff, alright? So you're starting with -1 this course, unfortunately. Yeah, both of you, and you'll share it, so you're going to learn. Your accomplices, alright? So, we're back to, you see, I forgot even my thought. So, the point is, these guys are totally incompetent to manage their own finances, but they continue to give to the rest of the world totally incompetent financial advice. Well, the advice is not technically incompetent. The advice is self-serving. When they are investment bankers and they provide financial or investment advice, the advice is never meant to make you money. The advice is meant to make them money. The problem is that when they make money, they got to make it off somebody, and that somebody is you, the investor. So you have to be extremely careful about investment banking and research analysts, which are known to be mostly corrupt. Another big issue is associated with IPO, and it's usually pumping up IPOs, okay? Pumping up IPOs where they hype the IPO, that's initial public offering, which represents an initial sale of assets, usually done by investment bankers as a subscription. We call the whole process of selling selling shares for the first time on the free market, we call underwriting, and the financial institution which assumes the risk for selling the shares at a fixed price, we call the institution underwriter. This is the institution which will guarantee. Well, there are different types of IPOs. You've probably studied some or probably not. Well, we learned later on, that when they were hyping, when they're hyping the stocks, usually stocks go up. They use very nice manipulation techniques so that when the IPO price, initial price is set at 10, that the IPO will get boosted to 15 or 20, and the initial buyers will get a lot of money upfront. In other words, they get quick money easily. They also violate the law, the intent of the IPO law, usually by pumping up the price and as soon as they pump up the price, because the law gives them 90-day period where they cannot sell their shares, or 180 days that they cannot sell the shares, they usually sell them by using a shell institution, not a separate institution, which on day 2 sells short. When the price is of the IPO is priced at 10, and on day 2 it reaches 20, it is in your best interest, if you're an insider, to sell out immediately. But because the law prohibits you to sell immediately, what is usually done is you get a separate institution, it sells short those assets, or those shares, and when it sells short, you effectively lock in the profit. Well, that's one hell of a great profit if you can lock in 100% in 2 days. Well, down the road, when the real shares, meaning those locked-in shares, it's called a lock-in period for 90 days or 180 days, usually come on the market. The supply overwhelms all the buyers, and the stock usually crashes, sometimes down the road. Not necessarily in 1 6, sometimes at the end of the first year, at the end of the second year. So when the stock usually crashes, the result is that all investors got ripped off one more time by the investment bankers and the insiders. In other words, there are 2 different ways to view investments. One is, let's find out what the correlations are. Let's assume that the market prices them perfectly. Let's construct a portfolio which is a mean variance optimal portfolio. That's the one way to think about it. The other way to think about it is the 101 ways which insiders, investment bankers, corporations, etc. are actually trying to cheat and manipulate the market in order to effectively profiteer at the expense of the average investor. You have to understand, in the long run, you're told that stock market is always good, right, and whatnot. In the long run, the average investor always loses. The average investor is always the ultimate loser. If some entities are making big money, who is losing the money? And the answer is the average investor is losing the money. There is no other way around. He is the small fish who is not in the game, who doesn't understand how the game is played, and who can easily get cheated out of his money without figuring what's going on. I mean, you can think of your own Saudi stock exchange. It has crashed since your wild and crazy bubble. It peaked at what, 22,000 or so? 24,000, and it's now at what? 4,000. So it has already fallen 6 times. Well, who are the big losers, all right? Who are the big losers? Yeah, the small little whatnot. We're going to discuss a lot more in behavioral finance and in technical analysis. Who are the winners, who are the losers, and whatnot. But the point is, to get you to begin thinking is that there are 2 different ways to think about it. And I'm just showing you the second, other type of thinking, which is not well presented in this textbook, but is usually presented in the regular literature. Now, section 1.4 in my textbook is the investment process. Alright, so the process discusses a portfolio, I already did. Asset classes, I already did. The next concept is, which is a key concept, of course, the most important investment decision is that of asset allocation. The asset allocation is essentially the choice of the components in your portfolio. Is the distribution between the different asset classes in your portfolio. And the distribution is usually measured in weights. So an asset allocation is the weight of each asset class in a portfolio, and we usually define it as weight 1, weight 2, weight 5. So it is we call it quintuplet, a set of 5 weights where you can say WI equals 1, and we only use 1 to 5 because we define exactly 5 asset classes. Other investors, economists, blah, blah, can choose 4 asset classes, then it becomes just a quadruplet, a set of 4. Again, the weights must necessarily weight to 1. There is also a possibility within the asset allocation, as most of the greatest investors of all time do, is to have a negative weight. Negative weight is interpreted as selling short the asset. To sell short the asset means that you sell what you don't have and you have a negative position. This simply means that, for example, to sell 500 shares short, you actually borrow the shares and then sell them, and later on, you buy them on the market and return or repay your debt. So there is a possibility for shorting an asset or an asset class. Technically, it may be a little bit more difficult. Legally, it may be impossible simply because the law says you may not short U.S. government bonds. I mean, I'm not saying there's such a law. I'm saying that a law may exist that may prohibit temporarily or permanently to short a particular asset for some reason. Whatever the reason may be good, the reason may be bad, meaning it may be economically and financially justified, it may not be justified. Usually those prohibitions are never made on an economic or financial basis. They're always made on a political basis to serve a narrow interest. Alright, so the asset allocation is the most important, and it usually determines, research claims, anywhere between 90 and 95% of the return in portfolio. In other words, let's take 2 years ago. You have only 2 assets. One is, let's say last year, you have stocks and you have cash. If you invested in stocks, you're going to be suffering anywhere between 20 and 30% losses across the globe, everywhere in the world. Exactly which stocks you pick wouldn't matter. You're going to be losing 20-25%. On the other hand, if you chose cash actually delivered 1 or 2% positive return. This is the basic risk-free return on a deposit. You would have gotten a different return. And no matter how great stock picker you are, you would not have, saved your losses. In other words, you would have still suffered substantial losses. During 2006, for example, you could have invested in commodities. It doesn't really matter exactly which commodity you would have invested. It could have been wheat, it could have been rice, it could have been copper, it could have been zinc. You could, throw the darts at the board of commodities. You're still going to get a great commodity return. In other words, the selection inside the asset class is not as important and is not as critical. But Wall Street will make you believe that this is extremely important, even though research clearly shows that it's not. I mean, every common sense person, if you get to look into it, will see how simple it is. Wall Street analysts will make you believe that the most important thing in the world is fundamental analysis, or the analysis which they deliver to you so that they tell you that this stock is great. Another thing to understand about Wall Street analysis is that when the stock market is crashing, let's say 20 or 30%, they have on 90% of all stocks a buy rating. Buy rating means that the analyst believes that the stock will, number one, provide a positive return, and moreover, in his own belief, the stock will most likely outperform the market. But, so 90% of stocks get buy, and if you buy only stocks which have a buy rating, you lose 25%. Well, that's not much of a great investment advice, all right? You got to understand all of those things. Unfortunately, as I'm saying, and they keep saying, is most of this stuff is not even present in the textbook. So I'm kind of trying to do a mixture of both as much as I have. All right, you have two types of analysis. One is top-down. The other one is called bottom-up approaches or investment strategies. The top-down approach means you first look at the global economy. Is the global economy booming or going in a bust? All right, is it going into a recession, possibly into a depression, or the global economy is hot and booming and everybody's pumped up and everybody's investing? Then you want to look at the industry. Once the global economy is booming, which industry is doing great? Well, 2 years ago, one of the greatest industries would have been the energy industry. All right? And then once you're into energy industry, you want to find out, well, do you want to buy Shell or ConocoPhillips or BP or Saudi Aramco? You know, so now you got to go down to the companies and provide a fundamental valuation and find out which one it is. So this is the top-down approach. The bottom-up approach is quite the opposite. You look into 100 companies, provide fundamental analysis, see which is good, see which is not good, try to see which is in what kind of industry. Oh, this is in car industry. Car industry is having bad prospects. Oh, this is food industry. Even though, we have supposedly a global deflation and overall prices are falling, food prices are going up. So, food industry and agriculture is good. In other words, you're trying to look in first at the companies, then look into what industry they are, then look at the prospects of the economy, and that's how you make your analysis. Warren Buffett is claimed to be using the bottom-up approach, where he just picks up the companies, while most or all of the greatest investors of all time always use the top-down approach. Warren Buffett is one of the great exceptions to this general rule. All right. So the next one is security analysis. You see, this is already starting out to be one-eyed man, a man who is blind. What's the point of blindness over here? No, is that they want you to think about security analysis, because security is a financial instrument and includes stocks, bonds, and in their world does not even include the currency itself. In other words, by using security analysis, they want you to be and to remain blind about oil. Well, you guys should know that oil is extraordinarily important, all right? It is probably the most important commodity in the world. It is rivaled only by gold. So it's easy to say that gold and oil are the two most important commodities in the world, and which is more important is a lot harder to say, because oil is strictly a commodity and a real asset, and gold is mostly a financial asset, and you can't say which is more important. Each has its own crucial role, one a bellwether and an indicator in the commodity world, the other one an indicator in of the financial world. You can't just say one is more important than the other. They are the two most important. Therefore, another derivative of extreme importance in finance is the gold-oil ratio. It determines, the ratio, which has certain dynamics I'll be explaining down the road. But the point is, they want you to stay blind to the concept of currencies. They just want you to think of 3% return on bonds and 12% return on stocks, being oblivious to the fact that the dollar fell 20%, as it did last year. and 20% for the year before that, and 15% for the year before that, alright? In other words, when you get to measure for those great booming years of the US stock market, from let's say 2002-03, when the stock market bottomed, roughly to 2007, for all of those, let's say 2, 3, 4, 5, 6, 7, the US stock market was booming and supposedly delivering extraordinary returns. When you measure those returns up against euro, it turns out that the returns were actually terrible. You were getting 1 or 2% negative returns. You were losing money. You would have been better off buying a European government bond, let's say a German bond, and holding it for its interest, and you get zero variability of return. You get a infinitely more, at that time and during that period, stable currency. So you get zero to no risk, relatively stable currency, and at the same time, you're assuming an extraordinary risk in the US stock market. Your return is, let's say, 15%, but the currency falls 20% against the euro, so when measured in euro, you're down 5%. In other words, you should not be aware of the currency effects in order to be well and properly manipulated. Once you begin to measure things appropriately, the picture looks radically different. When you get to hear investors like, and you will have to, because that's what your exams will be about, Jim Rogers, Peter Schiff, and whatnot. If you're going to be measuring stocks, you will measure the return of the stock markets in what? Are you guys learning here?
Gold.
Of course in gold. You gotta be measuring in gold. So if you're gonna be measuring things, the correct measure is called the Dow Gold ratio. This measures how many ounces of gold are necessary to buy 1 unit of the Dow. What is the Dow Jones recently?
7,000.
Alright, let's put it roughly 7,000. And recently, let's say gold was roughly 900. So it gives roughly, it takes roughly 8 ounces of gold to buy 1 unit of the Dow. Alright?
That was a currency or something? No.
Dow is 7,000. This is the Dow Jones Industrial Index. Okay, which was not until just recently about 10,000 or so, and gold is gold. All right. So, where was the Dow in 2000 or 2001, roughly? Well, it peaked about 11, 12,000. Now let's just say it's 11. It's not as important. I'll be showing all of those charts and graphs. And where was roughly gold about?
7.
Gold was roughly 250. Gold was roughly 250, alright? So, what you're seeing is happening is here, the ratios between, let's say, my mistake here, between 40 and 50. In other words, it took 40-50 ounces of gold to buy 1 unit of Dow Jones. Now it takes 8. The correct way to think about it is that gold outperformed Dow Jones from 8 to 50 or from 8 to 40 is roughly 5 times. In other words, you would have been 5 times better off investing in gold as opposed to Dow Jones. Well, just recently oil crashed big time. It may be temporary, it may be permanently. We're going to cover a lot more in this course. The question is, would it have been better if you invested in Dow Jones, or it would have been better if you invested in a barrel of oil?
Oil?
Of course oil. Well, what's happened with Dow Jones? Dow Jones has fallen roughly from 10, 11,000 to 7,000. So at this point, Dow Jones is down 20, 30%. Well, what about oil?
From 100 $100
No, you can't say 190 or 150. You gotta say, just use the same time frame. We're using the time frame of 2000 to 2009. In other words, if you invested for 9 years in Dow Jones, you're down 30% in nominal terms. Dollar has fallen maybe twice. So you're suffering extraordinary losses. I mean, once you factor in 30% nominal, 50% the loss of purchasing power, you're down easily 60 or 70%. Well, what about oil?
60.
The average was between 60 to 70. And
No. Guys, you are expected to know the price of oil year by year. In 2000, the price of oil was in the $10, $20 range. Even now, when it has already crashed from $145 to $40, you would have still at least doubled your money. Well, so the price of oil bottomed out at $8, $9 in 1999. So if you use the lower bound, you would have increased your money 4 times. And oil is a lot less riskier than stocks. Alright?
So notice the Dow Jones was 7,000.
Yes, correct. In the 90s, yes. So we're using the cutoff point. I mean, you could use any other cutoff point, alright? You can use any other cutoff point. But the point is different. What they want to do is teach you in time security analysis. And guess what? If they teach in every school security analysis, this simply means that when you take an analyst trying to analyze gold, he doesn't know how to analyze it, how to value it, because he doesn't study it. It turns out economists are extraordinarily incompetent in analyzing and valuing oil. Why? Because oil is not a security, and the standard security analysis does not apply to commodities, so they are totally hopeless, and in use instead guesswork. Whatever will work the company best. Well, there are other guys in the world who, instead of guessing, use real, good, solid analysis and get things right. And we'll get a lot more in coming lectures. We're done for today.